Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekly Update for the week of June 15th. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. As we do each week, Steve and I will provide a brief update on the global capital markets, and we'll take a little closer look at a particular topic which we hope could help our clients better understand the current market environment. This week, we're going to be discussing investing during a global pandemic. So let's get started and recap the week in the capital markets. And so, Steve, I know that you often describe the behavior of the market since the outset of the COVID-19 crisis as a tug of war between the benefits of massive monetary and fiscal stimulus on the one hand, and the negative economic impact of the COVID-19 global pandemic on the other. Now, during the relief rally in equities, the positive impact of monetary and fiscal stimulus and the reopening of the economy seemed to be winning the day. Equity markets have continued to move higher. However, recently there seems to be growing concern among investors about the possibility of a surge of COVID-19, with recent outbreak in Beijing, China, as well as increases in reported cases in the U.S., particularly in those states that had reopened their economies fairly early. So, Steve, could the markets be underestimating the possibility of a second wave of coronavirus-related deaths in the future?
Well, Fritz, I think the answer is yes, but not necessarily in the way that's been recently discussed in the media. I am on the board of the IHME, and we're having our annual meeting this week. And we have been looking at all the most recent forecasts and data that show what is likely to happen with the coronavirus. And I'm proud to say that we were rated the #1 most accurate coronavirus forecast. And what we've learned is that there are now even more data sources to account for detecting the most important inputs into what's driving the coronavirus. So human contact is a big one. And there are ability data sources from Apple, from Google, from Facebook that show very clearly when the shutdown happened, human contact went down by 80%, and already we've come back more than halfway. Population density is another big input. Testing per capita, country by country, has a big impact on the coronavirus. Wearing of masks was statistically stronger than we even anticipated. It really does make a big difference. The amount of pollution, smoking, altitude, higher altitudes are better situated. So all these are important factors, but there's one that strikes me as very important that's not been discussed in the media that I think could surprise investors. And that is that we've now found a very statistically significant correlation in seasonality, not with the flu, as some people have hypothesized, but with pneumonia cycles. And pneumonia cycles very well tracked and measured and have been happening over the years. And there's a very strong correlation between this coronavirus cycle and pneumonia cycles. And what it's telling us is a bit of good news and then a bit of bad news. The good news is that we're in the part of the cycle where it's coming down pretty sharply. So even though the media is talking about openings in certain states that might be a little premature, spikes in certain places, there's a general downward pressure on the coronavirus impact due to this pneumonia cycle. And the bottom should come sometime in mid to late August, if not early September. So we think there's a risk that the market is going to become complacent about the coronavirus because it might not be as bad over the next few weeks as people have guessed. But the bad news is that once it bottoms out, the cycle starts up again into September, certainly in October, and does not peak until New Year's. So we're afraid that that's going to bring a second wave, and that in the absence of mitigation efforts, and if the complacency gets so big that people stop wearing masks, people stop social distancing. This is not priced in the market. I want to turn to a graph that was recently produced by the IHME. And what this graph shows over time, going back from February, looking ahead to October 1st, a graph of the daily deaths in the US. You can see there was a very sharp climb from late March into April. And this is when the coronavirus hit hard. Hospitals were at max capacity in many places. And the economy just shut down, not just here, but in other countries. That shutdown had a big positive impact. And you can see the deaths per day peaked and started to come down rapidly. Until the reopening, this graph was projected to go down close to zero again by July. But because of the reopening, and in some cases premature reopening, we've seen this start to level off. But still, there's a downward trajectory until we get into the late summer months. And then the worry is to see an uptick starting in September and going up in October. And this shall continue based on the seasonality cycle all the way up until New Year's. So this is what we have to worry about for our clients.
Very good. I don't think that's priced into the market for sure. So sticking with the title of the today's session, Investing During a Global Pandemic, perhaps you could shed a bit more light on how here at 3Edge we seek to make informed investment decisions while at the same time living in such an uncertain period. I mean, a global pandemic, the likes of which the world has literally not experienced in over 100 years. And I suppose one answer to that is, well, we don't have any choice, right? I mean, that's the hand that we've been dealt. It's our job to do everything that we can to invest and preserve clients' hard-earned wealth in different environments, and we take that challenge seriously. But I think the question is more gets to the idea of whether or not the current global pandemic actually alters our investment approach and our process in any way. Maybe you could just touch on that.
Well, Fritz, the coronavirus does have a direct impact on our investment process. Core to our investment process is what we've developed, the global capital market model. And the whole idea is that model is meant to describe and analyze what we think are the key cause and effect relationships that affect the markets. Now, there are three categories of factors: valuation factors, economic factors, and behavioral factors. And they all impact market prices. And they're all impacted by what the coronavirus is doing. So, for example, there's been a lot of optimism that after bottoming out in April, the economy is showing a lot of signs of coming back to life. And retail sales were recently much stronger. GDP is not projected to be as negative, et cetera. However, even though that's the case, we are still not back to the level we were before the pandemic started. And that's going to affect sales that per share that are generated by the entire stock market. And that's a very important variable in our valuation model. And if sales don't go back to where they were before, even though they're growing from the bottom, if they don't go back to where they were, price to sales ratios become even more indicators of overvaluation. And that would affect the attractiveness of investing in U.S. stocks. Now, it is true that other parts of the world are not nearly overvalued like the U.S. market, but that's one place it impacts. Second would be on the economic factors. Big impact on credit spreads, or the difference between what lower credit quality organizations like companies that maybe don't have very strong balance sheets, the amount that they need to pay to borrow money versus the government or versus very, very safe companies. We saw in the beginning of the cycle when the market plunged, credit spreads widened very dramatically. Then we saw when the Fed came in and started printing literally trillions of dollars to support the market, credit spreads narrowed again. So that is being directly impacted by both the coronavirus and also the Fed response. But it's something we can measure and monitor every day and to see which side of that tug of war is winning at any point in time. Then finally, on the behavioral side, fear of the coronavirus has had a big impact on our behavioral variables in the model. And our behavioral variables are meant to track self-reinforcing feedback loops, or what you might call virtuous or vicious cycles. When people are less fearful, the market starts to go up. That encourages other people to jump on the trend. There's a fear of missing out, and that's a self-reinforcing virtuous cycle. But it goes the other way. And in the behavioral model we have, when you cross certain thresholds downward and the selling starts to create more fear, that creates the fear that it'll go down more and people get out, and that selling begets more selling. You have a vicious cycle. So we've tracked that on the way down. We're tracking that on the way up. And we are close to levels where if there is a market change in psychology and we begin a path downward, we might trigger some of those levels, get that vicious cycle going, and then that will change our model attractiveness and say to be even less in equities. So there is a big impact.
Very good. Very, very helpful. One thing that struck me when we think about the idea of, investing during a global pandemic is the importance of just reminding our clients that you and I and our whole senior team, we have all our money also invested in the 3 Edge strategies alongside our clients. And that means that, we eat our own cooking and we're all in this together trying to sort things out during this global pandemic.
Very true.
So that will do it for us. Steve and I will be back next week, another edition of our 3 Edge Weekly Update. Remember, all of our videos are available on our YouTube channel, and please feel free to share these videos if you think there might be someone who would be interested in listening to them. In addition, if you have questions or suggestions for a future topic for our weekend updates, go ahead and send along those ideas to us at our website at 3edgeam.com. So on behalf of Steve and everyone at 3 Edge Asset Management, everyone, we urge you to keep safe, stay strong, and keep the faith. And Steve, thank you again for your time and your insights.
Thank you, Fritz.
And thanks for listening.